Hello, my stock market jobber community. I hope you're having a good day. Just want to point out some important things going on in the market here. Now, one of the things I always talk about, and I think it's important, is that people need to understand that these pundits and these experts and so forth and so on that you see in the media on, Bloomberg or CNBC or Fox Business News or you read in some chat room somewhere, 98% of the time they don't know what the hell they're talking about. Okay, now I sound like maybe I'm kind of arrogant, but I mean, I don't know. I don't think I am. I did spend over 20 years in the institutional trading world, though. When I was there, I picked up a few things. I was a market maker. Yes, I oversaw the trading of hedge funds and mutual funds and so forth and so on. But here's kind of my philosophy, right? The market's never wrong. The charts are never wrong. Politicians are wrong. Analysts are wrong. But the market's not. Now, you've been hearing all this talk about how, oh, the banking sector is safe. There's a backstop. We're going to ignore the law and just guarantee people's funds, even though they have way more in a bank than they should because it's non insured. So let's just look at this here. This is an ETF, an exchange traded fund that tracks the banking industry. This is an aggregate of, I don't know how many banks are in this portfolio. It could be 100, but it's a good barometer of the banking industry. Now, here's where the panic started, or, the almost panic started, I guess I should say, at least for now. Who knows? Things could get worse, but you'll see what I'm talking about. But anyway, I just wanted to point this out before I get too into it about how important some price levels are. Notice how this was resistance back here, became support here. This happens because of seller's remorse. There's investors who sold who regret doing so when the price goes higher. So they tell themselves they're going to buy their shares back, but only if they can get them at the same price they sold them at. So if you have enough of these remorseful sellers placing buy orders, the level turns from resistance to support, and that's what happened here. All right, you don't need to be a chart guru or ninja trading master to see that that's the case. Now I'm going to go to a closer up version of the same chart. Now here's going back 6 months. Now let me ask you a question, right? Pretend you know nothing about stocks, and other than hey, if it's doing good, the company's doing good, it goes up, and if the company's doing bad, the stock goes down. This is where the banking almost panic or quasi panic, I don't really even know what to call it. This is where it started. Okay, here's that $35 level. This is called market memory. We can see how two and some odd years later the level was so precise. But let me ask you a question: does this look like a chart of an industry that's doing well? Does it look like it's been bailed out? I don't know. To me, it doesn't. If it did, I think the stock would go like that, right? We'd have it going up, but we don't. It's still going down. So I think that's kind of important. Now, if we get to this $35 level, which is support, which means there's a lot of buyers looking to buy around there, and we break through it, meaning we go lower, what does that tell us? It tells us that the investors who created the support with their buy orders are gone, they're out of the market. And this could end up becoming another big move lower, similar to this. Now, this isn't really a recommendation. If you want to trade recommendations, you got to check out my trade recommendation page, or I should say our trade recommendation page, because I have a lot of people that are very helpful. But let's just go back to this. The market is talking. The market talks. Does this tell you, hey, I'm the market. I'm about to recover? It doesn't look like it to me. It looks like we're still going lower. We can call this bad action, right? Bad action is something you can't quantify. If a company reports really good numbers that are better than estimates, but the shares still go down, well, that's bad action. Well, there's supposed to be this saving stuff going on in the banking industry, and doesn't appear to be that way in the charts. All right, let's go to our next chart here. Now, this is First Republic Bank. This is where it all got started. Actually, I take that back. I think it could have been Silicon Valley Bank, but regardless. Now, Obviously, you don't need to be a market guru to see that this is a crash. Something goes from 120 to 13 in 2 weeks. That can be called a crash. I don't think anyone's going to deny that. Have you seen any rebound? Does it look like we're reversing? I don't know. Not to me. Does it look like that to you? If it does, well, please, you know, please send me a notification on on YouTube, right? Does this look like it's a rebound? The way I learned this was a rebound means something's going up, not sideways or even arguably lower. So this goes back to that bad action, and I don't want to make light of it, but it, I think it teaches an important lesson: is that when the market is acting different than conventional wisdom dictates that it should, it's time to pay attention. And if this, Jerome Powell and Janet Yellen were really bailing this out and things were hunky dory, I would think that this thing would be, you know, up much higher. But the action is could be really telling us a lesson. Like, dude, this is not over, and it could even get worse. Now, this is kind of important here, right? Because what is the conventional wisdom? The conventional wisdom is like, all right, the little banks are doing bad. People are withdrawing money out of the little banks and they're putting them into the big banks. What are the two biggest banks? Bank of America and JP Morgan. So all these other regional banks that we talk about, well, actually Silicon Valley was really big, but there's all these little regional banks that the stocks are collapsing. People thought, all right, well, the little banks are going to have bad times, but the big banks are going to benefit from it because they're going to get a lot of money put into them from the people that are taking it out of the little banks. Bank of America, does this look to you like it's rebounding and going higher? Is this the action of a stock that's doing well? You know, listen, maybe I was in the trading world for over 20 years. Maybe I've overseen the trading of hedge funds. Maybe I was a market maker. Maybe I was this, maybe I was that. You don't need to be a genius to know that if a company's doing well, the stock, you know, the stock shouldn't be going down. So this says something to me here, right? The the smaller banks are in trouble, and the trouble is seemingly getting magnified or accelerating, I guess I should say. And now it's coming into the big banks, Bank of America. What's the other biggest bank? JP Morgan. Does JP Morgan look like it's going up? Not to me. This shows an interesting dynamic, right? Support levels can turn into resistance. There's investors who bought back here who regretted doing so when the price went higher, and then when the I'm sorry, let me take that back. There's investors who bought back here who thought they made the right move when the price went higher, but then when it falls through their buy price, all of a sudden they're losing money. And a lot of these investors tell themselves, you know, I made a mistake. I want to get out, but I'm only going to do so if I can get out at break even. So you have these remorseful buyers placing sell orders at the level that was support. And if there's enough, it turns into resistance. But that's a technical analysis lesson, and please make sure you check out our technical analysis lessons. I do one every day, and I apply it to the real markets at the real time. Although it all kind of comes together. It's all kind of the same, right? Because when we look at markets, we're looking at principles of supply and demand. But going back to this, J.P. Morgan, huge bank. I think this is even bigger than Bank of America. The stock just couldn't get above this resistance. The resistance is a bunch of investors who are trying to sell at the same price. The buyers just can't overpower them. There's too much supply and not enough demand. So, I guess just to kind of sum up here, the smaller banks were doing poorly. The narrative was that the government is going to save them with the backstop and the bailout. The second part of the narrative was, all right, money's coming out of the smaller banks and it's going to help the bigger banks. But what did we just see? JP Morgan and Bank of America, their stocks are looking pretty weak to me. And like I said, the charts don't lie. They know more than any analyst or any politician or whatever pundit you wish to reference. And then here's just one more thing, right? Money's coming out of these banks. It's been what we call like a flight to safety. Flight to safety occurs when people sell things and that they perceive as being risky, and they go into things that they perceive as being safer. The money was going into Microsoft and Apple, and this is the technology sector. Microsoft and Apple are about 45% of this. We can see we had resistance here. Once again, we have price levels that are more important than others, and we couldn't get through it, and now we're going lower. Now you might be saying, well, gee, Mark, why would people be buying tech stocks if they think the market's going lower? Why don't they just sell and just hold their money in cash? Well, here's why. In the institutional trading world, and I know everyone's so fascinated with hedge funds, I do check out the lesson on what a hedge fund is. It's probably not as exciting as you think. The only difference between a hedge fund and a different type of fund is the fee structure. But a fund has a typically have a mandate, right? That you can't be more than X percent of cash. Like if you have a mutual fund and you look in the perspective, it probably says this mutual fund cannot have more than 5% of its money in cash. It's got to be invested in stocks. So if you're the person who's running this mutual fund, you could think like, oh man, this market sucks. It's going to blow up. If I could, I would be at 100% cash. But you have no choice. You need to be invested in something. The contract that your investors signed when they gave you money says that we can't be more than, say, 5% cash or 3% cash or whatever it is. So the investment managers are forced to put their money into something. So they put their money into things they think will go down less than everything else. So let me just sum up. Banking looks weak to me. I think there could be a lot more coming, and it's not good. And the flight to safety going into these stocks that are perceived to be safe looks like that's kind of coming to an end too. So we could be going into the market could be about to trend lower here. All right. Thanks, everybody. I appreciate you checking me out, and I hope to talk to you soon.